We trust these little pieces of paper. That's all it is, just a piece of paper.
In 2024, only 24% of transactions across Europe were made with physical money. 13 countries don't have a single domestic payment option for in-store purchases. They rely entirely on American card networks. 2/3 of every swipe, every tap, every purchase flows through foreign infrastructure. And Europe's central bank is done watching from the sidelines. The euro didn't arrive as coins or banknotes. It was just numbers on a screen, an accounting unit.
€1 is worth 70 pence. It will be the standard currency in the 11 countries which have fixed their exchange rates to it. Euro transactions will only be in cheques and plastic cards until 2002, when coins and notes will be introduced.
3 years later, physical currency followed. It was the end result of decades of integration. One currency for a continent that had spent centuries at war with itself. Today, 350 million people, 21 countries, the world's second most important currency. But here's the thing. The euro was designed for the 1990s, a world of bank branches, ATMs, physical cash. Nobody predicted smartphones and contactless payments. Big tech platforms that now control how billions of people spend money. And now, the cracks are showing. The ECB will tell you they're building a digital euro to solve 3 problems: fragmentation, technological disruption, cross-border inefficiency. These are real issues, but they're also convenient stories that hide what this is really about: power. Let's start with the most obvious problem. Europe has no pan-European payment solution. Sure, cards work, but whose cards? American companies, processing European transactions on American infrastructure, Apple Pay, Google Pay, PayPal. European alternatives, fragmented by country, and they still rely on those same American networks underneath. For you, the consumer, this works fine. Tap your phone, payment goes through, you get your coffee. But for the ECB, every one of those transactions is a strategic vulnerability. Payment data flowing through foreign servers, terms of service written in California, economic sovereignty that depends on the goodwill of foreign corporations and governments. And this isn't paranoia. Europe watched Russia get cut off from SWIFT overnight. Financial infrastructure is geopolitical infrastructure. When the next crisis hits, Europe doesn't want to be asking permission from Silicon Valley to keep its economy running. Now add this. Cash is collapsing. In just 3 years, the share of businesses refusing cash has tripled. Online commerce has doubled. And this creates a problem most people don't think about. Physical cash is the only form of central bank money that you can actually hold. When you swipe a card or make a bank transfer, you're not using money. You're using a claim on money issued by a private bank. The intermediary is private. As cash fades, the central bank's direct relationship with the economy fades with it. The ECB can't stop cash from dying, but it can replace it with something that preserves central bank control, a digital euro. Then there's the innovation problem. The financial industry is experimenting with distributed ledgers, tokenized securities, smart contracts that automate transactions. The promise? 24/7 trading, instant settlement, massive efficiency gains. But there's a catch. If every blockchain platform settles in a different private token or stablecoin, Europe's financial system fragments, and the ECB loses its role as the provider of the ultimate settlement asset. Worse? If dollar-based stablecoins dominate, every transaction happens in dollars, settled on blockchain networks beyond European jurisdiction. The euro becomes just another token in a dollar-denominated digital economy. The ECB sees this clearly. If we simply rely on foreign private solutions, we will import technologies, standards, and dependencies, and risk fragmentation and instability. This isn't about transaction costs. This is about defending the euro's role in global finance. Central bank digital currencies started as academic papers. Then, China launched its digital yuan. Every central bank took notice. For the ECB, the digital euro solves everything at once: control and sovereignty. It gives the central bank a direct relationship with every citizen, anchored in European infrastructure with European rules. The digital euro would be legal tender. Merchants must accept it. And in extreme scenarios, the ECB could implement negative interest rates or program how stimulus money gets spent.
The digital euro would be a digital form of cash, with the same privacy and the same convenience. It would exist alongside cash, giving people more choice, online, but also when there's no electricity or no internet connection.
Privacy? The ECB says they won't see what you buy or who you are. Transactions use pseudonymous identifiers. Offline payments work device to device with no central record. But payment providers still see everything. They have to have anti-money laundering requirements. The distinction between the ECB can't see what you bought and the ECB can see everything except what you bought might matter to privacy advocates. But it's still unprecedented visibility into economic activity. And here's the irony. The digital euro also protects banks. Holding limits around 3,000 euros prevent you from abandoning banks entirely. Banks stay in control of customer relationships while being forced to support a system that could have destroyed them. Between 2023 and 2025, the ECB built the foundation. 1.3 billion euros for development, 320 million euros annually to operate. Every external provider, EU nationals controlled by EU nationals, 6 national central banks building the core infrastructure. This isn't a pilot project, it's a parallel currency system. At the end of last year, ECB closed the preparation phase of the digital euro and moved the project into the next build-out stage. This year, they're targeting for passing the main digital euro regulation in Parliament and Council. For 2027, earliest pilots and limited scope rollout would be penciled in policy and market analyses. By 2029, we should expect a full retail CBDC in the wild. But make no mistake, this shifts power. Today, Visa and Mastercard set the rules for digital payments. Tomorrow, the ECB does. Payment providers become utilities operating on public infrastructure, governed by a rulebook written in Frankfurt, and it goes beyond retail. For wholesale markets, the ECB is connecting blockchain platforms to central bank money, preventing fragmentation, eliminating credit risk, keeping the ECB as the ultimate settlement authority. For international payments, they're building networks that bypass correspondent banks and compete directly with dollar stablecoins. This is the bargain. The state provides infrastructure, the market provides services, consumers get convenience, banks get protection, and the central bank gets control. The privacy protections are real, more real than most payment systems, but it's privacy within a system of control. Infrastructure, rules, and settlement authority all belong to the state. The euro unified Europe economically to unify it politically. The digital euro ensures that unity survives the digital age, with the central bank at its center, setting standards across 21 countries, anchoring finance, competing globally. The ECB is doing what central banks have always done, defending the currency, the system, and its own role at the center of both. The question is whether the cure is worse than the disease.